All right, and good morning, good afternoon, or good evening, depending where you are in virtual classroom land. All right, so today's day two of the GPS 261LL, right, which is the learning lab. So in this lab, we've already done like the regular part of the class where we gone over the material and reviewed all. This is going to focus more on the actual, the test taking skills and strategies. So the first thing I'm going to do here is I'm going to go through a bunch of practice questions. We're going to go through this stuff from the this is about equities, and I just this afternoon I culled a bunch of questions out of the past perfect question bank. So I'm going to share these with you, and I'll read the question out loud. I'll read the answer choices, and you'll tell me what your answer is. And so since there's 7 people here, when 7 people have responded, we'll go through the question. So let me go ahead and bring this up to you now. All right, I think you can see it. Let me know if you can't. So the company declares a cash dividend that is 10% higher than the previous dividend rate. Prior to the announcement, the annual dividend yield was 8% and the stock was trading at $25 per share. What is the new dividend payment per share? A, 45 cents, B, 50 cents, C, 55 cents, or D, 60 cents. Now, there's a lot of stuff going on with this question, so use your scratch paper, just like you would at the test center. Use your calculator, just like you would at the test center. Right? They give you a basic 4-function calculator. So give you a moment or two, about a minute or so, see if you can work it out. And then I'll work it out with you. Okay, we got one answer. Okay. Okay, is there anyone else who's gonna answer here? Like, okay. All right, because I'm gonna go ahead and close this out and we'll just go ahead and walk through it, if that's all right. Otherwise, just tell me what you think, A, B, C, or D. Okay. All right, so here we got. So the company announced a cash dividend that is 10% higher than the previous dividend rate. Prior to the announcement, the dividend yield was 8%. That was okay. So the yield, right? That's the percentage rate of return. And the stock was trading at $25 a share. So what's the new dividend amount per share? Now there's a few steps involved, but you can work through it. First off, we figure out, well, what was the original dividend payment? It was 8%, but 8% of $25. So if we start with $25, well, what's 8% of that? Or multiply by 0.08, and you're going to get $2. Okay, so that was the original dividend, was $2, right, annually, $2 because that's the yield is always on an annual basis. But now it's 10% more than that. So if we take the $2 original dividend, now multiply that by 1.1. So like, because it's the original dividend plus another 10%. So it's like 110%. It's like, okay, so it's 10% more is like 110%. So what would that give you? That would give you $2.20. Right? 10%, or what's 10% of $2, right? 20 cents. It's 10% more. So now the dividend is $2.20. Okay, but that's on an annual basis, isn't it? But the question is, what is the new dividend amount per share? Dividend payment per share. How often? How did I get 1.1? Okay, because it's right 10% more, right? 10% higher. So if I multiply by 1.1, it's like, which is the same as 110%. The original dividend plus another 10% on top of it. Now, of course, I could do it this way. Okay, another way I could do it. Okay, or I could take the $2 dividend and figure out what's 10% of that, or times 0.1 is equal to, right, 20 cents. 20 cents. and I take the original $2 dividend plus the 20 cents more, and that comes out to $2.20 also. Right? They both work, right? Okay, good. Okay, but the thing is, though, the question is, what is the new dividend payment amount per share? How often do stocks pay dividends? Can you tell me? 4 times, right? 4 times a year, right? Or on a quarterly basis. So each payment, so we had to take that, we have to divide by 4 to find out what each payment is. $2.20 divided by 4 is 55 cents. And that is our best answer choice. Okay. Hey, look, it's all right. Like I said, this is all practice environment. And this question was kind of tricky, right? There was a lot going on in one single question. So let's try and prepare you for the, kind of a harder case sometimes, a harder scenario. Okay, let me get rid of this here. So let's get a more difficult scenario. Oh, you did 18% of $25? Ah, okay. That might have caught you up a little bit. No, it was 10% higher than the previous announcement. So no, not it doesn't become 18%. Okay. Okay. All right. Is everyone good with this one? Does anyone have any questions about it? Okay. Okay. So let's go on to our next one. Okay, and that is okay. Next question is: which term applies to common stock? A, convertible; B, redeemable; C, non-negotiable; or D, non-callable. Okay, 3 choices so far. Okay. 5 people so far. Okay, that's 6. Okay, so one more perhaps. Haven't you heard from Hannah? Hannah, are you still within earshot here? Can you see her what's going on? Or if you can send me a little quick hi sign if you're able to see and hear me, okay? All right. Well, let's go ahead and go through with this then. Which term applies to common stock? So this is a vocabulary question, right? And definitions. Is common stock convertible? Common stock is not convertible. Okay, things can be converted to common stock. Common stock does not convert into anything else. Is it redeemable? To be redeemable, that means if you want to cash out of it, you have to give it back. You basically give the common stock shares back to the issuer, to the company for cash. Common stock is not redeemed. Is it right? When you want to sell it, you have to trade it. You have to sell it to somebody else, which makes it negotiable. The term non-negotiable means that it can't be sold. And that if it can't be resold, it must be redeemed. So if it's redeemable, it's got to be. If it can't be redeemed, then it's got to be negotiated. You got to trade it. If it can't be negotiated, it's got to be redeemed. So, so those two basically kind of cancel each other out. Is it callable? No, it is a non-callable security. Yes, there is no right. There's no call feature. They cannot automatically cash you out of common stocks. Okay, there's not a call feature. There are callable bonds. There are callable preferred stocks. There are no callable common stocks. Therefore, our best answer choice is D. Okay. All right. So has anyone got a question about that? Okay. As always, if you're not totally 100% sure, please feel free to type something in chat or unmute and say, "Hold on." Okay. Which of the following influences the market price of common stock? A, the par value of the shares; B, the investor expectations about the future of the company; C, stated value of the shares; or D, book value of the shares. Got it? Okay, I'm counting 5. All right, a few more seconds. Okay. Because you might as well just give it your best shot. Because you don't leave a question unanswered on the real test, right? So that's automatically wrong. So don't leave it unanswered in the simulation either. Okay, but gotta keep moving. So I'm going to close this one out. All right. So which of the following influence the market price of the common stock? Well, there's a number of things that can influence it, but the real thing, of course, the real influence is expectations about the future of the company, which is it comes down to supply and demand. Well, what drives supply and demand? Right, future expectations. Par value of the shares of common stock is virtually meaningless. Basically, it's an accounting entry that shows up on the one line item on the balance sheet. The book value is its liquidation value. So if you said the company sold off everything that it has, right, went to cash, it would not include things like intellectual property, but anything, tangible assets that they can sell off or cash. Divide by the number of shares outstanding, that gives you book value per share. It can be important, but that's not what really drives it, nor does stated value, which is par value. So those are not really things. Expectations do, however. Yes, very good. The definition of treasury stock is A, issued stock minus authorized stock. B, issued stock minus outstanding stock. C, authorized stock minus outstanding stock. Or D, outstanding stock minus authorized stock. Tell me what you think. Okay, that's 3, came pretty quick. 4, all right. Okay, one more. Amy, do you have a thought about this one? Thinking? Okay. Thinking? Okay. Okay, good. So treasury stock. Well, this tells you more like, well, what's the formula of treasury rather than definite. Treasury stock is shares that have been issued, this company has issued to investors and subsequently repurchased. Right? The stocks that when they do a stock buyback, yeah, those are the shares are held in treasury. So they're known as treasury stock, which reduces the number of shares outstanding. Shares outstanding are the number of shares that are currently in the hands of investors. So if you take the stocks that have been issued, subtract out the ones that are still outstanding, whatever's left over must be treasury. Okay. An authorized stock is in the articles of incorporation, the corporation's bylaws. It would say how many shares of stock it is authorized to sell to investors. Now, they probably won't have to sell all the shares that are authorized, right? They probably don't need to raise that much money or capital. So out of that, some money will be issued, the shares that have been sold to investors. And then outstanding stock is the shares that are still currently in the hands of investors. All right. And all the things like formulas like earnings per share and dividends per share are based on outstanding stock. A corporation has issued 100 million shares of common stock at $1 par. The corporation has 25 million shares of treasury stock on its books. The aggregate value of the outstanding shares is A, $12,500,000, B, $25 million, C, $75 million, D, $100 million. Okay, 5 so far. Okay, so the company has issued 100 million shares of common stock at $1 par and has 25 million shares of treasury stock on its books. Well, like we just sort of went to, if you have issued shares minus treasury leaves you outstanding. And at $1 par value, that the outstanding shares is 75 million. Yes, correct. Okay, great job. Okay. All of the following are functions of the transfer agent except A, mailing dividend payments to shareholders, B, preparing and mailing proxies, C, setting the declaration date, D, canceling old and issuing new shares. What are your thoughts? Okay, I've counted 5. Okay, and I've counted 6. So all the following functions of the function of the transfer agent except first off events. Who's the transfer agent? Right, the transfer agent is hired by a corporation. Basically, is where their role is to keep track of the outstanding shares of stock, right? And who knows and who the shareholders are, keeping a list of who the shareholders are. So what do they not do? What's the function they do not do? Do they now, since the transfer agent has the list of shareholders? Yeah, one of their roles is mailing out dividend payments. They know who the shareholders are, so they know who to send the checks to. They know who to send the proxies to, which is for voting, proxy voting, annual reports, and yes, having outstanding shares of right when someone sells their stock, they bring in their paper stock certificate, cancels the old one, someone else buys it, they issue a new one with that new person's name on it. The one thing they don't do is set the declaration date. Who sets the declaration date? Can you tell me? BOD, you got it, the board of directors. Exactly. Yes, the board of directors sets the declaration date. Transfer agent is there to keep track of who the shareholders are. And that includes the mailing. Yes, right? Mailing out dividend checks, mailing out annual reports. Okay, common dividends are usually declared A, quarterly by the board of directors of the company, B, semi-annually by the board of directors of the company, C, quarterly by the chief executive officer of the company, or D, semi-annually by the chief executive officer of the company. All right, I've counted 6. I think we've counted correctly. Quarterly by the board of directors of the company. Hey, that was good. Okay, good. Yes, typically they are on a quarterly basis. It's a industry standard So it's a safe assumption for the test unless you're specifically told otherwise. Yeah, the dividends are paid on a quarterly basis. Corporate dividend payments can be made all the following ways except A, cash or company products, B, additional common shares of that company, C, additional common shares of another company, or D, listed options of that company. Okay, I think I've counted 6, and everyone chose C. The corporate dividends can be made in all the following ways except listed options of that company. Remember, options, right? Call and put options, they're not issued by the corporation at all. They're basically contracts between two different investors. And where do options come from? They're issued by and guaranteed by the Options Clearing Corporation, not by the corporation itself. Cash dividends, of course, right, are pretty common. They can issue common stock dividends where they give more shares of the company stock. This is exceptionally rare, so I'm not at all surprised that you would have looked at this one and thought that was true. But that the common shares of another company. It usually would be the subsidiary of that company, or maybe it's a subsidiary giving stock of the parent company. But it is possible to do that. But listed options, no, remember, options are not issued by the corporation. They have nothing to do with call or put options. Okay. Question says, why would they give shares of another company? I don't know that I've ever seen a real life example of that, by the way. Not that I can ever recall. But they could do it. Like I said, they could be the parent company giving shares of the affiliate of the subsidiary, or it could be the subsidiary giving shares of the parent company. It wouldn't be a totally unrelated company. I couldn't imagine that at all. Okay. Why did they do that? Well, they're trying to find some ways to reward shareholders, but okay, but don't actually have maybe cash without actually giving them cash. Okay. There is also, by the way, company products. They can do that too. Yeah, so they can. Like I've heard that. I don't know this for sure, but I've heard Starbucks, right, will give gift cards to existing shareholders. That's what I've heard. I once heard that Procter and Gamble used to give away soap to shareholders. All right, yeah, this one was a difficult one because it was something you've probably never seen or heard of before. But if we just remember, listed options are not right. The corporation's got nothing to do with listed or standardized options. Stockholder approval is needed if a corporation wishes to do all the following except A, split its stock 1 for 2, B, split its stock 2 for 1, C, repurchase shares for treasury, D, issue convertible securities. Okay, I think that is 6 people have answered. Everyone chose choice C, and I agree. Choice C is the best choice, right? Repurchase, it does not need shareholder approval to repurchase shares for treasury because actually that is kind of a benefit for them because remember, what's the value of the stock, right? Supply and demand. By buying its own shares back again, they've just reduced the supply. So if the demand remains the same, that should increase the price per share. And when they report things like earnings per share, right, it's based on shares outstanding. So by putting stocks in the treasury reduces the number of shares outstanding, will increase earnings per share. Now, things that do affect like the stock split, which affects the par value, of a stock. It's kind of a restructuring of the company that requires shareholder approval. By the way, stock dividends do not require shareholder approval. The stock dividends are giving out shares of stock basically from retained earnings, right? From basically, funds it has, from left over from, from its profits. Issuing convertible securities requires shareholder approval because there would be a dilution effect. See, if they issue convertible bonds or convertible preferred stocks, and if investors start converting them into stocks, that's going to have a dilutive effect. That's going to dilute each existing share and reduce the earnings per share. So therefore, that requires a shareholder vote too. Which statement is correct concerning cumulative voting? A, it allows for a proportionate voting weight and helps smaller investors. B, it allows for a proportionate voting weight and helps larger investors. C, it allows for disproportionate voting weight and helps smaller investors. Or D, it allows for disproportionate voting weight and helps large investors. Okay. All right, so there's a difference of opinion here between choices A and C. Everyone agrees that cumulative voting helps smaller investors. Absolutely true, because it allows voters to accumulate their votes or stack their votes. Okay, and if enough small investors stack their votes the same way, they could outvote the large investor. But because of that stacking vote, that allows for disproportionate voting. Yes, it's right, by being accumulative, they can vote disproportionately. They can throw all their votes for one board member candidate and none for the other two. That makes it disproportionate. If it were proportionate, they'd have to vote equally for each thing to vote on for each board member candidate. That makes it proportionate. Okay, and if it was proportionate, that helps larger investors because the more shares they own, the more votes they get. What do they call what's the term for that one? What's the proportionate voting that helps larger investors? If it's not cumulative, what's the other one? Stat, okay, which I think will be an abbreviation for statutory. Good. Oh, right, you're doing great. Yes, perfect. Statutory voting, right? Because you have to vote equally, right? Proportional. All your votes are frozen like a statue in statutory voting. Nice. Common shareholders have all the following rights except A, right to inspect corporate books. B, right to vote for the annual dividend rate. C, preemptive right. D, residual claims to corporate assets after all other claimants in a dissolution. Okay, everyone's voted on this one. And good, you did that quickly. Okay, good, because you are correct. Right, common stockholders do not have voting rights for the dividend payment. Right, the dividend is entirely up to the board of directors. Shareholders do not get to vote to pay themselves dividends because if they could, I'm sure they would, and a big hefty dividend at that. They do have the right to inspect corporate books, though, but fortunately, you don't have to go marching into company headquarters and say, I demand to see the books, because they will send them to you. You'll get your annual reports from them. You do have preemptive rights. If the company issues more shares of stock, you as an existing shareholders get the first right of refusal on those newly issued shares. You get first chance to buy them in a rights offering. And yes, you do have the right to residual claim after all the other claimants. Well, which is a fancy way of saying you're last in line as a common stockholder if there's a bankruptcy liquidation. Because first they have to pay off all their debts, right? And then if there's money left over, they pay it to preferred stockholders. And if there's money left over after that, and don't hold your breath, then it goes to common stockholders. All right. More than that, though, I noticed how you did that really quickly. That's good because, after all, the real test, you're working against the clock. So you want to be kind of like the idea of like you can't rush through the test because if you speed read through it, they're going to catch you off guard. But you can't take too much time either because the clock's going to run down. So you got to try and find that balance. FINRA sets which date? A, declaration date. B, record date. C, X date. D, payable date. I counted 5 so far. Okay, a few more seconds. Okay, smoking begun. We got to review this one. So FINRA sets which date? Okay, so those are the dates that we know they're recognized in the dividend payment process. Okay, thanks. Okay, so what are the dates? So who set? Okay, so FINRA, which one do they set? They set the X date or X dividend date. Remember, X means without. So X dividend means without dividend. Anyone who buys that stock on the X dividend date or later will not receive the next dividend payment. They're basically too late. Who sets the other 3 dates? You got it, the board of directors. Perfect. Yeah, so they'll put, remember, the board sets the dividends, right? So they'll put out, first off, they'll put out the press release. The declaration date is when they put out the press release, make the announcement to the world. And it goes something like ABC Corporation will pay a dividend of, and then we'll say how many dollars and cents per share. And we pay to everyone who's a shareholder of record as of such and such date. Now, that such and such date is the record date. Anyone and everyone who's on the books with the transfer agent as a close of business on this date gets the dividend payment. And then they'll say the payments will be made on so and so date. Well, that so and so is payable date. That's the day the checks go in the mail and the day brokerage accounts are credited. Okay, but in the over the counter stocks, FINRA sets the ex dividend date. Right? If it's on this traded on a stock exchange, it's the stock exchange that sets the ex dividend date. But the ex dividend date is set when? How many days prior to the record date? Or I should say business days? 1 business day. You got it. Okay. T+2 is the settlement period, but the reason that the X date is 1 day before the record date is because of the 2 business day settlement period. Because but when they buy it, remember, it takes 2 days to actually deliver or to arrive. The settlement date is the day the buyer takes possession. So if they buy it 1 day before the record date, it takes 2 days to arrive. So it doesn't get there until 1 day after the record date, 1 day too late. So that's why the ex dividend date is 1 day ahead of the record date. And if that does that make sense? And if it doesn't, if it's not clear, please let me know. Okay. All right. A client owns 100 shares of Cosmo Company common stock. The client receives a notice that Cosmo has declared a 10% stock dividend. What does this mean? A, the client will receive 10 additional shares of Cosmo stock. B, the client's aggregate stock holdings will increase in value by 10%. C, the client must return 10 shares of stock to Cosmo. Or D, the client's aggregate stock holdings will decrease in value because of the additional shares. Okay, that's 1, 2, 3, 4, 5, 6. Okay, 6 people answered. There's still some difference of opinion on this one. But in a stock dividend, a 10% stock dividend, that means that the company will give each shareholder 10% more shares than they had before. So if someone has 100 shares now, they're going to get 10% more. What's 10% of 100 shares? 10 more shares. So therefore, our best answer is A. Now, what will happen to the aggregate value of the stock holdings? Will his value go up by 10%? He's got 10% more shares, right? No, the value stays the same before and after, because while I have 10% more shares, the value per share will be reduced proportionally so that the aggregate value or the total value stays the same before and after. Yeah, it's got to stay the same before and after. Aggregate means the value in this. Yeah, it means total value. Yes, total value. No, they don't have to return 10 shares. I've never seen anything like that. And no, the aggregate, the holding will not decrease. It stays the same before and after. Number of shares increase, value per share decreases proportionally. So the total stays the same before and after. That's how you know you did the math right. If you do it, if you're trying to figure it out, you do a checksum after that, then you know you did the math right. And this one, no, that was it. That was it for this group. Okay, good show. Let's see. We're about 7 minutes to the top of the hour right now. Since I didn't have any more questions in this group, let's go ahead and take a quick break. Let's go ahead and take a 10-minute break, and we'll come back and I'll bring up something else. Okay. So return at 4 minutes past the hour. Okay, so we'll do that for a 10-minute break. All right, so what I'm going to do next, I'm going to do a little quick lecture part of it, okay? So I'm bringing up the PowerPoints again, because as I've gone through questions, I've gone through people, their quizzes and scores, I found a couple of areas that more people seem to have a little bit more trouble with. So we just want to go over those real quick to kind of get that part back up to speed. All right, I'll see you in a few minutes. Okay, hi, folks. Welcome back from break. And again, if I may confirm that I am welcoming you back, right? And I haven't lost my connection or anything like that. Can you send me a little bit quick? Oh, okay, there we go. This definitely is a little bit better. It helps if I hit the unmute button. Okay, all right, so let's make sure we're welcoming back you from break. Okay, thank you, Alexis and Ashley. All right, that's 2 people. That's a good start, right? Okay. Well, anyway, I'm going to take that as a good sign that things are still working properly. All right, so what I want to do back is kind of go back to the part of the lecture here, because as I mentioned, right, as I reviewed people's questions and quizzes, I found a couple of areas that still seem to be maybe sometimes they'll get a little bit harder here, or some people are having a little more trouble with. So, and it can be really important. So I want to make sure we go over this stuff and that we all got it down. So this is about first part about bond prices and quotes. Okay, so this one, okay, so a bond is quoted, right? When you get a price quote on a bond, the convention that they use is that the number you see represents a percentage of its par value. So it's quoted in points, okay, and one bond point is the same as 1% of its par value. Now, what is 1% of a $1,000 bond? 1% of $1,000 is $10. So every bond quote is $10. And like it says here on the screen, if the bond is quoted at 80, it's just a shorthand notation for 80% of its par value. Par value is set at $1,000, industry standard, so it's a safe assumption unless you're specifically told otherwise, and I really doubt you'll be told otherwise. So if I said the price was 80, it's 80 points, which is $800. So that would indicate, by the way, that this is a discount bond, right? It's trading for less than 100% of its par value. So it's trading at a discount to par value, in this case, $800. Now, if the price was quoted at 110, again, that's a shorthand notation for 110% of its par value. Now, again, if it's 110 points and every point is $10, it's $1,100. So you can take the number that they give you and multiply by 10, or move the decimal point one place to the right. Okay, all works out the same way. Okay, but this one, of course, is $1,100. This indicates it's a premium bond, right? Trading at a premium over and above its $1,000 par value. Now, the way it works with corporate bonds and municipal bonds is that they are quoted in fractions of an eighth of a percentage point, in fractions of an eighth, and it's always done at the least common denominator. So the price quote will go from, well, 98 to 98 and 1/8, 98 and a quarter, 98 and 3/8, 98 and a half, and so on. So when you give it to them in a fractional format like 98 and 1/8, the first thing that we do is convert decimal into, fraction into decimal. So what is 1/8 in decimal format? Now you can always use your calculator. In fact, again, I encourage you to use your calculator for any math problem. Just take 1 divided by 8, 1 divided by 8 in your calculator. Come on now, 1 divided by 8 in your calculator, and you'll get 0.125. Yes, exactly, actually. Well, 0.125. So if the quote is 98 1/8 in fractional format, then it would be, right, 98.125 in decimal format. Now that we see it in decimal format, you can multiply by 10 or move the decimal point one place to the right, and it works out to $981.25. So that would be the market price of this bond. Okay, it's just quoted in fractions of an eighth and always moves just in eighths of a point, not any finer distinction than that. Now this one says it's quoted at 102 and a quarter. Okay, well 102 and a quarter, this might be a little easier to do. 1/4, 1 divided by 4, is equal to 0.25. So the price quote is 102.25 percentage of par value. Now to move the decimal point one place to the right, $1,022.50. Okay. Good. It's not any harder than that, and just a bit of practice and you can get that down. I've just got to the point where I've memorized it, that 5/8 is the same as 0.625. How do I know? I've just done this so much that I've got it memorized now. That's all. Okay, so this is very important when it comes to quotes. Now, Treasury bonds, however, right, issued by the federal government, they work a little bit differently. They also quote as a percentage of its par value, but they have to draw finer distinctions. It is a much bigger market, right, than corporate or municipal bonds. A lot more government bonds are being sold because, after all, the government borrows a lot of money. So they have to draw finer distinctions than just an eighth of a percentage point. Their quote is a percentage of par in fractions of a 32nd of a percentage point, or 1 divided by 32, 1/32. That's how much, because they have to draw such finer distinctions. Since it's understood that they're quoted in fractions of a 32nd, the number you see, they quote a whole number and then a fractional number, but always known that it's a fraction of a 32nd. So everything that you see to the right of the punctuation mark, it tells you how many fractions of a 32nd. So this bond quote says it's 98:01. So after the punctuation mark is 01, which means 1/32nd percentage of par value. Now again, if you grab your calculator and divide 1 divided by 32, that gives you, well, it's already on here, but I'll show it anyway, 0.03125. Now you see there's all kinds of decimal places here, right, out to 5 decimal places. So 98:01 is 98.03125 percentage of par value. And now that we see it in decimal format, move the decimal point one place to the right. Now, of course, that will come out to $980.31 Okay, right. Now, at this point, of course, we're going to round it off to the nearest penny. So $980.31, okay, because we can't get finer than a penny. Okay, this one example here is a premium bond. How do you know? It's greater than 100, greater than 100%. 102:24 or 102.24. Since it's understood that the 24 represents how many fractions of a 32nd, 24 divided by 32, crunch that in your calculator, is 0.05. So therefore the price quote is 102.05 percentage of its par value. Now again, move the decimal point one place to the right, $1,027.50. Okay, it's just that simple with just a bit of practice. That's something you can get down pretty easily. Okay. Now I should mention here, because it doesn't mention this on the slide. No, it doesn't show here. So let me put this here. depending on the quotation source, maybe the newspaper you read it from. All right, you might see nine like this one, 102:24, or you may see 102.24 or 102-24. Whatever you see, right, to the right of the punctuation mark is how many fractions of a 32nd. Now, the trap they might try and set for you is they give you this in 102.24. Well, if you read that as you would for a corporate bond, and you figure just move the decimal point one place to the right, you might think $1,022.40. That might be one of the false answer choices if you didn't notice, right, or you forgot that this was a treasury bond quoting in fractions of a 32nd. So you have to take the extra step to go how many 30 seconds and put that into decimal format. All right, so when we get a dealer, right, when we're buying and selling bonds, bonds are generally bought and sold in the over the counter market, right, in the dealer market. So there are dealers in securities that say, as a dealer, they'll say, I'll buy it this price and sell it that price. So the price that the highest price that anyone's willing to buy it from you now at this particular moment, that's the bid price. The lowest price anyone's willing to sell it to you for at this particular moment is the ask price, which is also known as the offer price. Ask or offer mean the same thing. They're synonyms. So therefore, if your customer or you wanted to sell a treasury bond, you would sell at the bid price because you're selling to the highest bidder. If you wanted to buy a treasury bond, right, you pay the ask price. You'll pay what someone's asking for it. Now, the difference between the two prices, that's called the spread, and that's the source of a dealer's income, right? As a dealer, they buy at this price and sell at that price, and they make the difference in between. So here we have this question. It says, a customer sold their January 23 Treasury note. What will the customer receive? So we got a list here of the different Treasury securities, but this one, right, was the January 23. That means it matures in January of 2023. And here it is on the list, right? The top one on the list. It's got a rate. It's got a coupon of 5.25%. So, but that's what it pays in every year. But the bid here, right now, it says they're selling, right? They're selling. So which price do they sell to? The bid price or the ask price? Right? They're going to sell to the bid price, selling to the highest bidder, and the quote is 99.24, which, as we know, is a shorthand notation for 99 and 24 30-seconds percentage of par value. All right, now again, I'm going to use my calculator and take 24 divided by 32. I get 0.75. So therefore, in decimal format now, 99.75% of par value. And now move the decimal point one to the right, $997.50. Okay. Everyone think they can do that? If we had a problem like this, you think you can do it? Okay, thanks, Ashley. Anyone who thinks maybe you need a little more practice? Okay, getting 3 thumbs up here. Like that. Okay, like this one here. What about the January 25 Treasury with a quote of 96.12? Can you tell me what that is? How would you work that out into dollars and cents? 96.12. Okay. All right, Alexa says thumbs up. Okay, $963.75. All right, well, let's check this out. So 12 divided by 32 is 0.375. So our price then is 96.375 of par percent of par is $963.75. Bullseye. Okay. Alexis and Alicia, yeah, you aced it. Great. Okay. You're right. Alicia, remember, you just got to remember to move the decimal point one place to the right. And that will tell you what it is in dollars and cents. Okay. Yeah. It's good to say it's 96.375% of par value. You can definitely do that, right? Okay. Good. Okay. Now, when their bond quotes are sometimes priced as a yield. See, what we just called to is they call them dollar bonds. Okay, and term bonds are usually expressed in dollar bonds. As a term bond, remember all the bonds that they've offered to raise the capital, right? All have the same start date and the same maturity date. But when they're offered as serial bonds, that means they all have the same start date, but they have staggered maturity dates. So some mature sooner and some mature later, right? Okay, it's like one of my coworkers had writers like boxes of cereal that all have different expiration dates on. So they're usually quoted not so much in as a percentage of par, but they're quoted as a yield. Remember, yield is their percentage rate of return, and the quote is done in basis points. A basis point is the minimum possible increment when we're talking about changes in yields or talking about changes in interest rates. And a basis point is the same as 1/100th of a percentage point, or 0.01%, or is 1/100th of a percentage point of 1%. You can also say it's 0.0001 too. You can do it that way too. So the minimum possible increment in change, for example, a bond is yielding 5.01% and then goes to 5.02%. Okay, that is 1 basis points difference. So if we say if a basis point is 1/100th of a percentage point, you could also say that 100 basis points is the same as 1 percentage point. So if you hear him on TV saying something like, oh, the Federal Reserve has just raised interest rates by 25 basis points. Well, if you hear that says 25 basis points, that is the same as 0.25% or 1/4 of 1%. Okay, so if the bond, as it says, gone from yielding 5.1% to 5.2, that's 10 basis points. And from 5% to 6% is 100 basis points, right? So that's okay. So sometimes they're quoted as yield rather than so much as percentage of par value. Okay, next part we want to look at, because again, I've noticed that some people seem to have a little more trouble with this one, is how the effect of interest rates changes, what effect that it has on the price of bonds and on yields. Okay, the thing to remember, of course, is that because, see, bonds are a fixed income investment, right? When they're created, they have a locked in stated interest rate, and that interest rate does not change. So it's going to pay the same amount of interest every year for as long as the bond exists. If it was a 6% bond, for example, it's going to pay interest. It's going to be 6% interest on the $1,000 par value, $1,000 loan. Well, what's 6% of $1,000? $60. So it's going to pay $60 a year in, year out, and will never change. That's what I mean by fixed income. It's locked in and stays the same. Well, the thing is, though, is that if interest rates change, well, that's going to affect the value of this bond, and of course, in an inverse relationship. So, as we say, if interest, let's say you got a 6% bond, but new bonds coming out now, right? Interest rates have gone up, and new bonds pay 7%. Well, if you wanted to sell your 6% bond, how are you going to convince someone to buy it from you? Because they can get a 7% bond that gives them $70 a year, okay, someplace else. So how can you convince someone to buy your bond from you? Well, the only way you could is to drop the price, right? You have to drive, right? The price would have to go down to such a degree that they're buying it at a 7% rate of return, right? A 7% return on their money. So it'd have to go down by enough to make it worth their while. So that's why when interest rates go up, the market price of bonds go down. On the other hand, if you have a 6% bond that delivers $60 a year and new bonds coming out now pay 5%, your 6% bond looks pretty good, doesn't it? Okay, and therefore it's worth more, and its market price will be bid upwards appropriately to the point where if someone bought the bond that paid 6% a year, they'd pay enough that they're getting actually a 5% return on their money, a 5% yield. So interest rates go up, the market price of bonds go down, right? It's an inverse relationship. That's why it's often illustrated with a seesaw diagram. Because with a seesaw, right, if one side goes up, the other side goes down. So that's just a good visualization. Now, there's different types of yields. There's different types of ways of measuring the rate of return. That's why there's a few types of yields. The basic type is the nominal yield. Now, the word nominal means name. It is the named interest rate. And that is the name that's given. If you had the bond certificate, it would say, right, stamped right on it, right? 5%, 6%, 7.75%, whatever it says is going to be the stated interest rate. And therefore, the payment that it receives is going to be based on as a percentage of the $1,000 value. If it said 5% bond, it's 5% interest on a $1,000 loan, and 5% of $1,000 is $50 a year. And this bond will always pay $50 a year for the life of the bond. Comes in the form of two $25 payments every spaced 6 months apart. So the nominal yield, the named interest rate, never changes. What does change, though, is the current yield. And the current yield is the return on investment based on the current price. That's why if the current price changes, the current yield changes. And you can actually figure out the current yield if you take the annual interest payment, and you know the annual payment when you know the when you know the nominal yield, and divide that by the current price. So here's the example they give us is a 5% bond trading at $800. Well, its nominal yield is 5%, but what's its current yield? Well, if a 5% bond pays $50 a year, but if somebody bought the bond at a discount, if they paid $800 for the bond, they're still receiving $50 in interest payments, but they're getting that on an $800 investment. So what's their return on investment? Well, crunch 50 divided by 800 in your calculator, and you'll get 0.0625, okay, which you then move the decimal 2 places to the right, to be 6.25%. So it's a 6.25% return on their money. Does that make sense? Is there any questions on that? Dad, plug in this. Okay. Okay. Is that all right? Okay. All good with that one? Okay. Thanks, Alexis. Okay. All right. The other example, they give us another example here, is a 5% bond trading at a premium of $1,200. Now, in this case, the price has gone up from 1,000 to 1,200, and we know there's an inverse relationship, seesaw, right? So if the price goes up, what must happen to the yield? If the price goes up, the yield must go down, because if someone will still receive $50 a year in interest payments, but if they're getting on a $1,200 purchase, well, take 50 divided by 1,200, and you'll get to about 4.17%. You probably have to round that down to 1 or 2 decimal places. And yes, for the test, you'll round it off to 1, maybe 2 decimal places. Okay, I think I did this from our last one here. I said a 4.75% bond. I want to make it a little trickier than just say, oh, flat even 5%. Because what does a 4.75% bond pay in interest? Well, you can crunch that. You can use the calculator, right? 1,000 times 0.0475. But a faster way is, all right, take the number you see, 4.75, convert it to decimal format. That's 4.75. Erase the percent sign and move the decimal point 1 place to the right. So 4.75% is $47.50 a year in interest payments. Price quote is 102.5, which we already see in decimal format. Move the decimal 1 to the right is $1,025. So receiving $47.50 a year on a $1,025 investment is about 0.046 or 4.6%. So again, the price has gone up from $1,000 to $1,025, and the yield has gone down from 4.75 to 4.6. So when people ask, which formula should I know for the test? Well, okay, the answer, of course, is whatever they're going to ask you about, but I want to suggest the first one to learn is the current yield formula. And unfortunately, it's an easy formula. Okay, but also why? Because this same formula can show up in different places. You see, this, when applied to a bond, they call it a current yield. But if you apply the same formula to a stock, they might call it a dividend yield instead. It's the same formula, just gets a different name. So that's why that can be important. Okay. Now the yield to maturity, all right, YTM, this is the return on investment, but in this case, it assumes that the bond is held all the way to the maturity date. Also, it works on the assumption that the interest payments that they collect are going to be reinvested at the same rate of return. So there's a certain time value of money into that. So the yield to maturity is just basically assumes that the bondholder holds it until the bond matures. Now, it's because the bond maturity date, well, that's the day the loan comes due. That's the day the bond issuer, the borrower, repays the loan and gives it back to the bondholder. Well, how much is the amount of the loan? Well, every bond is a loan for $1,000, right? So that's its par value. So the bondholder is going to receive a check for $1,000 on the maturity date. Now, the thing is, though, of course, what if somebody bought the bond at a discount? What if they bought the bond for $950? Well, they'll still get $1,000 when the bond matures. Well, that's an extra $50. So that's like a bonus for holding it all the way to maturity date. Well, if we factor in the fact that they'll collect interest payments, but also factor in this bonus that they get for buying it for $950 and it comes due at $1,000, factor that in, and that's going to affect their yield, which is their rate of return. So that becomes their yield to maturity. Now, if they're going to get more money for holding the bond to maturity, well, getting more money would just have the effect of increasing their yield, which is their return on investment. So therefore, if the price has gone down, the nominal yield stays the same because it's always the same. The current yield goes up, and we can calculate by how much, but that's because they just bought it at a lower price. And the yield to maturity goes up more than that to account for this extra bonus for holding it all the way to maturity date. Now, of course, the exact opposite happens when the bond's trading at a premium. A premium bond means it's above its par value, more than $1,000. But the bondholder still gets $1,000 on the maturity date. So if you bought it for $1,050 and you get $1,000 later, that's a built-in loss of $50. Okay, so if you count in this built-in loss, well, if they're going to lose some money on that, well, what's that going to do to their return, right? It lowers their return, it lowers their yield. So when the price goes up, a premium bond, the nominal yield stays the same, always the same. The current yield goes down because they had to pay a higher price for it. And the yield to maturity goes down more than that to account for this built-in loss for buying for a premium and getting $1,000 back up. Okay, so while the slide here says you do not need to calculate yield to maturity, and I think you probably won't, the test is much more concerned that you understand the relationship between how do change in price affect the different kinds of yields, not so much that you can do the math. So that's why I put up here, right, the kind of question you might see. A 6% bond matures in 10 years at 95. Okay, I should probably say quoted at 95. Otherwise, it might say come due at 95. Quoted at 95. What is the yield to maturity? All right, well, you know that this is a discount bond, right? It's 95. And you know its nominal yield is 6% because it told us, right, the named interest rate. We know that the price has gone down because it's 95%. So therefore, if the price has gone down, the yield goes up. So we've just eliminated choices A because that's a lower yield. And we eliminate B because it's the same, right? It says it's got to go up. So now we're left with either C or D. Well, we can calculate the current yield pretty quickly. 6% bond, $60 a year, off of a $950 investment, 60 divided by 950, that works out to about roughly 6.3%. Well, we know it's got to be more than that, so we've just eliminated choice C. What are we left with? D. Okay, so by process of elimination, we're actually able to figure out the answer without actually figuring out the answer. Okay, so this basically kind of repeats what we just said here. Okay, so if you take the discount bond and say, okay, what's the total benefit of the discount bond, right? Is the interest rate, the coupon, right, that it receives, but also the value of the bond as it basically grows in, as it increases in value as it gets closer and closer to maturity, right? Because this bond is going to increase in value, it's going to stair step upwards in value. Now, it tells us here the customer buys a 10% bond, okay, $1,000 par value, but bought it at a discount of $900, and there's 10 years to maturity. So they bought it for $900, and 10 years from now, they'll get $1,000. So there's $100 difference. So we're going to take the $1,000 that they get later on, subtract out the $900 they paid for it, and that's going to be a $100 difference. So that's going to be the extra bonus that they get. But it's going to take 10 years to get there, right? So divided by 10 years. So basically, this bond is going to stair step upwards in value, right, at the rate of $10 per year for the next 10 years. So the total benefit from this bondholder, they get the 10% interest rate, which of course is $100 a year, plus 10% in annual accretion. The word is accretion, by the way, right? But okay, so it accretes at the rate of $10 a year. So the total annual benefit is $110 a year. So if we need to figure out the yield to maturity, there is a formula for it, and this is the basis of the formula. Is this okay? So the $100 annual interest payments, $100 interest payments, plus the $10 per year in appreciation or accretion in value is a total annual benefit of $110. So that's what we put in the numerator, right? Rather than just the annual interest payment, we take the interest payment, in this case, plus the accretion. So it's worth $110 a year. Now, to divide that, we can divide that by, okay, instead of dividing it by the current price, what we do is we take the average of what the price of the bond is and what they get on maturity. Now, you know where the average is something, right? You add the two numbers together. So they'll get $1,000 on maturity, but they bought it for $900 now. Okay, and if you average that, divide by 2, right, you get $950. Okay, so averaging the two prices together. So in the calculator, right, so the numerator is going to be $110 in annual value, and then divide by the average of the purchase price and what they get on maturity, $950, and that's our formula. $110 divided by 950, so I'm going to take 110 divided by 950, and I get 0.1157. Let's round it off to 1.116, which would be the same as 11.6%. That's how you do yield to maturity. Like I said, will you need to do that for the test? Not very likely. But now you've seen it. So, hey, if ever they ask you about it, at least now you know. Okay, now it talks about the premium bond. Okay, and basically the bond is bought at a premium. They paid more than $1,000 for it, but of course they get $1,000 when it matures. So this bond is going to stair-step downwards in value, right, as it gets closer to maturity. So we're going to subtract the depreciation on it. Actually, the word is amortization. Okay, as it goes downwards in value. So in this case, the customer bought a $1,000 bond, but paid $1,100 for it, right? So if we take the amount that they receive, $1,000, and and subtract out the $1,100 they paid for it, okay, well, that's going to be a minus $100. So basically, they're going to lose $100 over the course of time, over 10 years' time. So therefore, this bond will depreciate in value or amortize in value at the rate of minus $10 per year. So its annual benefit now is the $100 in interest payments minus the $10 in amortization. So the total annual benefit is actually $90 per year. Okay, and then of course you divide that by the average of what they bought it for and what they'll get on maturity date. So the average is $1,100 they paid for it, plus the $1,000 that they get on maturity date, and average that out, divide by 2, and what is that? That would be $1,050. So our magic formula now is $90 in total annual benefit divided by $1,050, which is the average of the two prices, and I get, I get 90 divided by 1,050, and I get 0.0857, or let's round it up to 0.086, or 8.6%. Okay, now you know how to do yield to maturity. So in the unlikely event that they ask, but hey, once you got the formula, right, when you know the formula, you got the answer. Okay. Now the best way to visualize, of course, as you've probably seen this before, is the seesaw diagram. Okay, so it's just something, draw this on your scratch paper or the marker board that they give you, so you'll have this visual reference in front of you. So in the case when the bond is trading at a discount, so the price is on the left side and the yield is on the right side. But when the price goes down, This shows us the nominal yield in the center, right, which is the fulcrum of the seesaw, the part in the middle that never moves. So that means the nominal yield is in the center, that stays the same. The current yield goes up, and the yield to maturity, when the bond is held all the way to the end, goes up even more than that. The exact opposite happens, of course, if the bond's trading at a premium. The price on the left side has gone up, which means the nominal yield in the center stays the same. The current yield goes down, and the yield to maturity goes down even more than that for the amortization of the bond. And of course, the bond is trading at exactly $1,000 at par value. Well, then the price hasn't gone up or down. Therefore, the yield hasn't gone up or down. So this looks like a flat seesaw. All right, so that's the part here. So this kind of sums things up here. But that's the part I wanted to go over because I noticed more people seem to get lower scores on these sections. Okay. Is there any part of this that you need, again, a little distinction, a little more extra help with, anything at all? Or was this feeling like old ground to you? Is this feeling like ancient history already? Okay. Well, since nobody's replying, I'm going to assume that you've all fallen asleep. Oh, okay. Thank you, Alexis. Okay. All right. All good. Thank you, actually. Appreciate it. Okay. Let me go ahead and pause this. Okay. So welcome back. So what I have now is I have another series of practice questions that PassPerfect provided in a presentation form. So just like the other ones, okay, I'll read the question out loud. I'll read the four answer choices, and then you tell me what you think is the best answer, right? Type it in the chat, and you choose A, B, C, or D. And if you, by the way, if you're so inclined as to why you chose that way I get to see like how's your thinking process work. So that can work well. That'd be very valuable too. So, and then when everyone's answered, we'll walk through the question together. I'll point out the key words. I'll tell you how we worked it out. What if I see this, I think that kind of thing, and then I can point out what makes one the best answer choice and makes the others maybe not such a best answer choice. All right, if we're ready to go, okay. Hopefully, Karina will join us here momentarily. But here's our first question. Here's our first question. Which of the following municipal bonds should be trading at the lowest dollar price? A, 4.8 coupon, 7.1 basis, M25. B, 6.8 coupon, 8.3 basis, M30. The screen isn't shared. Oh, that's what a brilliant idea. Thank you for keeping me honest. All right, so now you're able to see the screens, yes? All right, good. Okay, question one. Which of the following municipal bonds should be trading at the lowest dollar price? A, 4.8 coupon, 7.1 basis, M25. B, 6.8 coupon, 8.3 basis, M30. C, 7.2 coupon, 6.5 basis, M35. D, 6.0 coupon, 8.6 basis, M40. Okay, so reading this question here, all right, what we're looking for, which one do you think is the best answer choice out of four? So far, I've got three answers. Four. Okay, anyone else is going to be able to go in and have an answer? Like, for example, is Amy? Okay, thanks, Amy. I was just about to ask you. Okay. All right, so there's some difference of opinion. Most folks choosing between A and C. All right, so first off, the question is which of the bonds should be trading at the lowest dollar price? So we know if the price goes down, then what happens to the yield? The yield goes up, right, compared to its coupon, right, which is nominal or named interest rate. And basis, well, basis, right, another word for basis is yield to maturity, YTN, right? Yield to maturity is a synonym for basis. So first off, if the yield has gone up, then because the price is, then yield the price because the price has gone down. But so therefore, are there we can start off by eliminating any answer choices that are clearly false? Well, if you look at choice C, that's a 6.5 basis, but that's the yield, but the coupon, the interest rate is 7.2%. Well, in this case, the yield has gone down. If the yield has gone down, it must be because the price has gone up. This must be a premium bond. So this will be trading at the highest price rather than the lowest price. So we've just eliminated choice C. All the others are discount bonds, right? Because the yield is greater than the coupon. But which would be trading the lowest price? Well, there's a couple things that factor into it, right? Is the amount of how much does the price of a bond move based on changes in interest rates? Well, one thing, of course, is the deeper the discount, well, then the greater the price volatility, the greater move downwards. But also factored in is the length to maturity. How much longer is this bond locked in paying lower interest rates? Like choice A, for example, all right, 4.8 coupon, but the yield is 7.1%. So it means bonds are paying like 7.1% now. This one pays 4.8%, so you had to discount the price. So it's locked in paying a lower interest rate, but only for another couple years because this matures. The M is for matures. Okay. It matures in just another couple years here. So it's locked in paying a lower interest rate, but only for another year or so, a year or two. So you wouldn't have to drop the price that much. It's not that big a deal before you get your money back. But if you look at choice D, right, it's a 6% interest rate, but it's yielding 8.6%, but it doesn't mature. It matures in 2040. It's locked in paying a lower interest rate for another 17 years. That's a big deal. You really have to discount the price to convince someone to buy that from you. So out of our four answer choices, our best answer choice is D. Does that make sense as to why? Is there any part of that that doesn't feel totally clear? The longer the bond is locked in, right, the greater the volatility, right? Because right, it's locked in at a lower interest rate. That's why, by the way, why do money market funds, why do money market securities have such a low volatility? Why are they considered cash equivalents? It's because they mature in less than a year, sometimes a lot less. So if it's going to mature in like 2 months, right? Okay, and interest rates go down, you're going to get your money back in 2 months anyway. So it doesn't make that much of a difference. Okay. Anyway, I saw a thumbs up and I saw horns blowing, so I think that is making sense. Yes. Okay. Good. Next question is: which of the following would be a quote for a U.S. government bond with a dollar price of $1,012.50? A 101.25, B 101-8, C 101 and a quarter, or D 101 and 4/16. Okay, I've counted 4 so far. 4 responses. Okay, I think that's number 5. Okay, I think Karina is still got some of those is helping her folks. So, which would be a quote? Okay, here's the thing, right? It's specifically a quote for a U.S. government bond with a dollar price of $1,012.50. Now, mathematically, all 4 of these choices work out to $1,012.50. But since it's a U.S. government bond specifically, we know that government bonds are quoted in fractions of a 32nd. And it's just understood that way. So the 101-8 is again a shorthand for 101, 101 and 8/32 percentage of par value. Well, now that we see it in fractional format, convert fraction to decimal, which is 101.25 percentage of par, which then move the decimal 1 to the right is $1,012.50. They all work out mathematically the same, but since it's a government bond, the convention is in fractions of a 32nd. Whatever you see to the right of the dash is how many fractions of a 32nd. Had this been for a corporate bond or a municipal bond, then the best choice would have been C, 101 1/4, because they're quoted in fractions. Now, yes, it's true. I've seen plenty of practice questions where they already had it in decimal format, 101.25, but is its most strictest interpretation 101 1/4, because they're quoted in fractions of an eighth. Nothing is quoted in fractions of a 16th, so choice D is just absolute rubbish. A 30-year bond is issued with a 6% stated rate of interest and is callable starting in 10 years at 102. It is now 11 years later, and market interest rates for similar bonds are now at 9%. Which statement is true? A, the coupon rate of the bond will be changed to 9%. B, the coupon is likely to be called by the issuer. C, the credit rating of the bond is likely to be lowered. D, the market price of the bond will fall substantially below par. Okay, I've just counted 5 people, so let's go ahead and check this out. Okay, again, there's a little difference of opinion on this one. So a 30% bond, right? It has a 6% stated rate of interest, which is the same thing as a 6% nominal yield or a 6% coupon, which means it pays 6% interest on a $1,000 face value, which is $60 a year. It also says it's callable starting in 10 years at 102. It's now 11 years later, which what does that mean? The bond is now callable, right? They can now cash out the bonds from the investor. See that 10 years right there? That's called call protection, which means that okay, for the first 10 years, the bond cannot be called away. They cannot cash them out early. If they do, they have to pay them something extra, 102, meaning 102% of par value. How much is 102% of par value, right? $1,020. That is known as the call premium. Okay, what they have to pay to the bondholders over and above the par value for the inconvenience of having their bonds cashed out from under them. So market interest rates are now 9%, which would be true. Well, I don't think anybody chose choice A, and that was good because A is not correct. The coupon rate is fixed when the bond is graded and never changes. Will the bond be called by the issuer? Now, the reason an issuer would call the bond in, why would they cash out investors early? They're more likely to want to do that if interest rates go down. Then they can cash out this old bond, which had a high interest rate, and issue new bonds at a lower interest rate, and save lots of money on interest payments, kind of like refinancing. I don't think they'd want to do that now, cash out a 6% bond and issue a 9% bond. I don't think they'd want to do that. Will the credit rating of the bond be lowered? Not very likely, because the credit rating is, well, it's basically someone's assessment, okay, about how likely it is that this corporation will be able to pay the bonds back again. So that wouldn't really affect it. Will the price of the bond fall substantially below par? Absolutely, right? Because this 6% bond pays $60 a year. New bonds pay 90%. And, right, it's like 11 years into a 30-year bond. So it's locked in paying a lower interest rate for another 19 years. So that's, again, a really big deal. So they really have to discount the price of this bond to convince someone to buy it from them. Okay. Which of the following is true of a bond's yield to maturity? A, the yield to maturity increases as the price of the bond goes down. B, the yield to maturity of a premium bond is higher than its current yield. C, as the yield to maturity decreases, the price of the bond goes down. Or D, the yield to maturity of a discount bond is lower than its coupon rate. Which one do you think is the best answer? Okay, 4 people have answered. Okay. Which of the following is true of a bond's yield to maturity, right? The yield is, okay, remember, yield to maturity is the rate of return assuming it's held all the way to the maturity date. And on the seesaw, remember, that's the far end of the seesaw, where the bond is held all the way to the end, like the end of the seesaw goes up and down the most. All right, now this is where it's basically asking about the relationship between the price and the yield to maturity. So what happens to the price of the yield, or vice versa? As we know, it's an inverse relationship. When one goes up, the other goes down. The only one that shows an inverse relationship is, yep, choice A. The YTM increases if the price of the bond goes down. Yes, that would, yield goes up, price goes down. That's exactly it. All the other three, those represent a parallel relationship or a consistent relationship. So, okay, so those they go in the same direction rather than opposite directions. Oh, you're thinking yield to call. Okay. Yeah, we got to be careful, right? Make sure we read the questions exactly as written. Okay. Got to be awfully careful because you know how these guys are really nitpicky for detail. Okay. As interest rates move, which statement is true regarding bond price volatility? A, the shorter the maturity, the greater the bond price's volatility, or bond's price volatility. B, the longer the maturity, the lesser the bond's price volatility. C, the lower the coupon rate, the greater the bond's price volatility. Or D, the higher the coupon rate, the greater the bond's price volatility. Okay, how's that so far? Is it making sense? Are you good with that? Mhm. Okay, welcome back, Karina. with an exclamation point. Okay, hello. And a smiley face too. Okay, now I've counted 6 people have answered. And which one do you think is the best answer choice? Well, it looks like everyone here has chosen C. And the truth is, I am going to agree with you. Okay, because the lower the coupon, the greater the volatility. Remember, the coupon is the interest rate that the bond pays, right? And therefore tells you how much cash flow is coming in, right? How much the bondholder receives in interest payments. And anytime someone collects cash, to some extent at least, that offsets the risk. The volatility is the size and frequency of up and down price swings, right? Right? Low volatility looks like this, and high volatility looks like that. And the um, and the volatility is the source of the risk. Okay, because risk means uncertainty. So more up and down price swings means more greater uncertainty. Now the coupon, the interest rate that it pays, helps offset the risk. And of course, if it's more money's coming in with a higher coupon, there's more cash flow coming in to help reduce the risk. Lower coupons have lower risk. Now A and B, well, first off, the opposite is true for both of them. Okay, shorter maturities have lower volatility because they're not locked in for as long. Longer maturities, locked in paying this interest rate for a longer period of time, the greater the level of volatility. And anyway, A and B kind of cancel each other out because they sort of say the same thing. C and D, therefore, say the opposite things. Right? These are opposites. C and D are opposites. And by the way, I've just made an observation, just taking practice questions over and over. I have noticed that if 2 of the 4 answers are opposites of each other, there seems to be a better than average chance it's one of those 2. So if you're really stuck, at least you can play the odds. Okay, so in that case, maybe you can tell me what type of bond would have the greatest volatility of all? Okay, we know if the coupon rate, right, bases part of the volatility of the bond, so which one would have the greatest volatility, the most up and down price swings? A zero coupon. Awesome job, Alexis. Perfect, because a zero doesn't make regular interest payments. There's no cash flow coming in to help offset the risk. So the volatility of a zero is greatest of all. Okay, good. Okay, given the same nominal yield for each bond, arrange the after-tax yield for each of the following bonds from highest to lowest. Government bond fund, municipal bond fund, corporate bond fund. A, government bond, municipal bond, corporate bond. B, municipal bond, corporate bond, government bond. C, municipal bond, government bond, corporate bond. Or D, corporate bond, government bond, municipal bond. Right, make sure you read questions carefully. Make sure they understand what they're asking. Okay? Okay. Okay, I think everyone's answered, and there's some difference of opinion here. So check out, because the question is, given the same nominal yields, remember that's the same named interest rate, which means it pays the same dollar amounts in interest payments, right? If it was a 5% bond, they pay $50 a year. All of them would pay $50 a year. So the question is arrange the after-tax yield. After-tax yield is not what you make, what do you keep? What do you get to keep after taxes? So therefore, government bond, okay, out of these types of bonds, which one do you get to keep the most of after taxes? If they all pay the same interest rate, how much do you get to keep? Well, municipal bonds are federal tax exempt, and our federal taxes are higher, so therefore we get to keep more of our money. So the municipal bond has the highest after tax yield. Government bonds are state tax exempt. Now, state taxes are lower than federal taxes, so you get to keep some more of your money, not quite as much, but you still get to keep some of it. So government bonds would have the next highest. Now, corporate bonds have no special tax treatment. They are fully taxable as ordinary income on both federal and state levels. So the corporate bond, you actually get to keep the least amount. So if they all pay the same interest rate, how much you get to keep? Our best answer is C. Muni, government, corporate, because of the taxability, the relative taxability of these bonds. Had the question says arrange them from highest to lowest yield, right? Not even after tax yield, just highest to lowest yield. Corporate bonds have the highest yield because they have the highest risk. Government bonds have the lowest risk, right? Government guaranteed, very safe, so they have a lower yield. And municipal bonds, because of the federal tax exempt status of them, they have the lowest nominal yield of all. But that question was not arrange them by nominal yield, it was arrange them by after tax yield because they have the same nominal yield. Okay. I just want to make sure if anything's totally clear. If not, hey, interrupt me, okay? If you got any kind of question, if you don't think you got it just yet. Thanks, Karina and Alexis. Okay, next one. Okay. Actually, before we go to our next one, I've got 6 minutes past the hour. And again, okay, I think it's time to give you another break. Okay, is that all right with you? Because it's been about an hour, so we don't want to. Okay, we want to give it. Okay, we got to give our brains a moment, right? So let's go ahead and break and return at let's see, 16 past the hour. Okay, if you'd like me to go back to another slide, if you have a question, comment, anything at all, please let me know. You can unmute, or probably best if you unmute because then I can hear you, because if I step away, I won't see the text. So I'll see you in a few minutes. Okay, hello, and welcome back from break. Okay, and still connected, right? Okay, thanks, Alexis. Thanks, Ashley. Wonderful. Are you ready for our next question? Okay, good deal. Let's check it out. Next question is, in 2015, your client purchases a July 32 Poughkeepsie Geo 4% callable at 101 in 27 in the secondary market for 102. If the bond is held to call, the yield to call earned by your client is most likely A, greater than the yield to maturity, B, equal to the yield to maturity, C, lower than the yield to maturity, or D, not enough information to answer the question. What do you think? Okay. I've counted 4 answers so far. I'm sorry, 5. 5 answers so far. Okay, a few more seconds. Okay, because I'm going to close this one out. So make a guess. Okay. So what happens? So basically, what is the question about yield to call, right? Okay, we know that yield to call is the most volatile yield, right? Even more volatile than yield to maturity. The reason is because it speeds everything up, right? It accelerates the whole process. Instead of having to wait 10 years to get their money back, maybe it gets called away from them, they get it money back in 5 years. So this bond was purchased, right? It was bought in the secondary market for 102. It's a premium bond. And even if it's callable away at 101 for $1,010. So it'd still be called in at a premium in case it gets cashed out early. So therefore, since the price has gone down, the nominal yield stays the same, the current yield goes up, the yield to maturity goes up more than that, and the yield to call goes up even more than that. So, sorry, this is a premium bond. So the price went up. The nominal yield stays the same. The current yield goes down. Okay, got to draw that seesaw. The current yield goes down. The yield to maturity goes down even more, and the yield to maturity goes down even more. So our best answer is C, lower than the yield to maturity. Yeah, that's some. Okay, it's like mixed opinion on that one, but that's the reason why, right? Bond was bought at a price went up, yield went down. Choice D, not enough information. Okay, I am super skeptical before I choose something like not enough information, cannot tell, none of the above, because whoever wrote the question couldn't think of a plausible sounding false answer choice. Because really, what do you got, right? Greater than, equal to, or lower than, what else is there? Okay. Okay, for it to be equal to yield to maturity, the bond would have been bought at par and callable at par. Next question. Carmen purchased an ABC Corp bond last year for $800. The bond will mature at par. She just received her second semi-annual interest payment of $35. What is this bond's nominal yield? A, 7%, B, 8.75%, C, 10%, or D, $279. Okay, I was getting a little nervous when no one's answered for a while, so appreciate it. Okay, thanks for answering. Okay, it's fine to change your mind. Okay. Okay, I think everyone's answered. All right, so this is a case where what's the question? We're going to read the question carefully. The question is, what is the bond's nominal yield? Nominal means name, it's the named interest rate. She received her semi-annual interest payment. She received $35, right, interest payment, but it's semi-annual, right? That means every 6 months. So we double that to figure out what that is. That's $70 per year, and it's $70 out of the $1,000 face amount of the bond. Well, $70 out of 1,000 is 0.07 or 7%. So that is the bond's nominal yield. Its named interest rate is 7%. The fact that Carmen bought this for $800, was that relevant to this question? Not at all. It was not relevant at all. It was not based on the nominal yield. Had the question been was the current yield, then the fact that she bought it for $800 would have been vitally important. But that wasn't the question. And this question, they're trying to set you up, okay, by putting in irrelevant details to get you to focus on the wrong thing and get you to start second guessing yourself. The best way I know to deal with, like irrelevant detail or distracting information, okay, is to read the last line of the question. Sometimes, if it's a long question, I sometimes read the last line first, because then I'm hoping I can pick out key words, tell me what I should focus on, and hopefully I can eliminate, right, irrelevant or distracting details. All right, any questions? Are we good with this one? Our next question is, the city of Peoria, Illinois is an outstanding $100 million of 7% general obligation bonds, M39. The bonds are callable at 103 beginning 1/1/19. The bonds are currently trading at 104.5. The call premium on the bond is A, 1.5 points, B, 3 points, C, 4.5 points, D, 5.5 points. Okay, you can change your mind, no problem. Okay, you can change your mind back, not a problem. Okay, anybody missing? Okay, ready to answer this one then? Okay, so what it tells us, right? The bonds are callable at 103, okay, and the bonds are currently trading at 104.5, and it asks what's the call premium on the bonds. So we have, well, what's the definition of call premium? Call premium is if the bond is called away, right? That means the issuer cashes out the investors prematurely. They have to give them something over and above the par value to make up for that inconvenience. So being callable at 103, that would be, right, 1,000, well, 100, 103 points or 103% of par value or $1,030, an extra 30 to cover the inconvenience of having their bonds called away from them. Okay, so therefore the call premium is B, 3 points over and above the par value. And the fact that the bond was trading at 104.5 was irrelevant to the question. Right, smoke screen, right? Irrelevant detail just to throw you off course. Just distractions. So we've seen now a couple questions where they've used irrelevant detail, right? So now you have an idea, what to look out for. So you ever going to get caught in that kind of thing again? Doubt it. Okay. Okay, Alex, is that a face palm there? Okay. Okay. All right, but now you have an idea. Okay, so when you get to the real thing, yeah, you're going to be prepared for that kind of tricks. Okay, as long as you know your stuff and you're paying attention to detail, you're going to see through their tricks. Okay, okay, you just got to be ready that the tricks are there. Of the following risk, which is typically the biggest risk to a fixed income investor? A, inflationary risk. B, business risk. C, currency risk. Or D, liquidity risk. Okay, we've counted everyone's answer. So of the following which is again typically the biggest risk, okay, to a fixed income investor. Now bonds, of course, are a fixed income investment because they pay this locked in rate of return, right? This locked in interest rate doesn't change. Uh, Preferred stocks are a fixed income investment too. They pay a fixed dividend amount that doesn't change for as long as it keeps going. So these are all potential risks here, but what says which one's typically the biggest risk? Well, if there's one that's typically the biggest risk, and pretty much to all bond investors, inflation risk or purchasing power risk. The risk that inflation is eroding the value of their investments while they're waiting for them to grow or to mature. So all bonds are subject to that. Now, of course, we hope that the interest rate that it pays is going to keep up with and hopefully exceed the inflation risk. So they actually end up coming out ahead. Business risk is the risk you've invested in a business and the business is not performing as expected. And maybe the values of investments reflect this underwhelming performance. Not quite the same as credit risk or default risk. Default risk or credit risk is the risk that you buy a bond, you lend someone money, and they don't pay you back. That's credit risk. Now, business risk can be tied to credit risk, but it's a little more precise. Credit risk is also the same thing as they default on the loan. Currency risk would apply to foreign investments. So because you have to convert, right, a foreign currency back into US dollars. And if the exchange rate between euros or yen or pounds or Australian dollars or pesos or shekels, okay, becomes less favorable, you don't get as many US dollars for the same amount of foreign currency, and there's a loss of income as a result. And liquidity risk is the risk of how difficult that might be to, well, basically liquidate, to sell an investment. Okay, so sometimes it's easier to get into an investment than it is to get out of one. Things like government bonds and high grade corporate bonds, no real liquidity risk. There's always a high demand for them. High yield corporate bonds, the one with lower credit ratings, and municipal bonds, that can be an issue. Okay, because those are thinner markets. They don't trade as actively. Which of the following is an example of systematic risk? A, credit risk. B, political risk. C, liquidity risk. Or D, interest rate risk. Okay, I think you've got an answer from everybody. So which is a systematic risk? Now remember that a systematic risk is a risk that's, well, inherent to the system. Okay, it's a risk that is part and parcel. If you have those types of investments, you have that type of risk. It does not help to diversify against a systematic risk because all investments of that type face that kind of risk. So you can't spread that type of risk around. It's really like a market risk. In fact, market risk is a systematic risk. It's a risk that would affect the entire market for a particular investment. So which one is a systematic risk that affects all the investments in that? And that would be D, interest rate risk. Because if interest rates go up, the market price of bonds go down. And that's true for all bonds, right? It's just sometimes it's a matter of degree. Okay, in fact, it doesn't help you to have a bond fund against interest rate risk because all the bonds that it holds. Okay, now non-systematic risks are individual risk, right? To a particular company or particular industry, you can spread out the non-systematic systematic risks by diversifying the portfolio, right, and having lots of different investments. That's where mutual funds come in because they give you this instant broad diversification. Credit risk, also called default risk, well, that's the risk that they don't pay your money back. Okay, if you put all your money in the bonds of one, if you put all your money buying bonds of one company and that company goes out of business, you're out of business too. You put it into a bond fund with hundreds of bonds in different investments and industries. A few of them go out of business, or a few of them default. You still got hundreds more still working. Political risk applies to foreign investments, okay, where they change in another country's policies, or its procedures, or its laws or regulations, or a coup d'etat, right, might adversely impact an investment. I would consider Brexit, for example, to be a political risk. Because remember, for a while, there was like, what's going on here? Okay. And we just mentioned liquidity risk about how easy or difficult it is to liquidate or sell investments, and you can spread that type of risk around. Interest rate risk is part of the system, you can't spread it around. When the yield curve is inverted, which of the following statements are true? 1. Short-term rates are lower than long-term rates. B. Short-term rates are higher than long-term rates. C. To maximize income, an investor should invest in short-term maturities. 4. To maximize income, an investor should invest in long-term maturities. Is the best answer A, 1 and 3, B, 1 and 4, C, 2 and 3, or D, 2 and 4? Okay, I think that's an answer from everybody. 2, 3, 4, 5. Yep, all 6. So the yield curve, right? What's the yield curve, right? It's a graph of the basically of the bond market at the time, where it compares the yield, right, which is return on investment, that's on the vertical axis, versus the length to maturity, right, which will be on the horizontal axis. So it says, okay, with bonds with different maturities, what different yields do they have? Okay, and normally the yield curve is like what they call a positive slope, where it goes from lower left to upper right, right? So short-term bonds have a lower yield and long-term bonds have a higher yield. And you expect that because investors expect to get paid more for agreeing to tie up their money for a longer period of time, right? Which also exposes them to a greater, to more risk for that time. So that's how it normally is. But every once in a while, the yield curve starts to flatten as economic conditions change, and short-term rates are not that much different than long-term rates. And every once in a while, pretty rare, but it does happen sometimes, the yield curve flips upside down, where it's a negative slope. It goes from upper left to lower right, showing that short-term bonds have a higher yield, a higher rate of return, and long-term bonds don't. Okay, now that's usually in response to economic conditions, especially in response to the Federal Reserve actions. Because when the Federal Reserve is changes interest rates or starts to tighten credit, yeah, it affects short-term rates to a far greater degree than long-term. So number 2 is true. Short-term rates are higher than long-term, and therefore, yes, to maximize income, an investor should invest in short-term maturities because it's saying they're going to get a higher yield from it. So our best answer choice is C, 2 and 3. Okay. And like Kimberly says, yeah, we're currently in this inverted yield environment because, right, the Fed is like this really rapid clampdown, right, in tightening interest rates after lowering them, right, from COVID world to really low rates. And then, well, inflation started to rear its ugly head. So they had to put the, basically put the brakes on. So, yeah, so that's kind of what happened, right? So, yeah, like you said, we're in an inverted yield environment currently. Okay. An investor seeking a high level of income and a moderate level of risk would buy A, common stock, B, mortgage bonds, C, income bonds, D, convertible bonds. 1, 2, 3, 4. Let's see. One. Oh no, six. That's six answers. Okay. All right. With some difference of opinion, an investor seeking a high level of income. That's one thing, right? And a moderate level of risk. So we're kind of like we have to check two boxes, right? High level of income, moderate level of risk. So which would we choose, or which could we eliminate? Well, for one thing, common stock. Common stock has a high level of risk, certainly compared to bonds, right? The volatility of the stock market is much more so than it is of bonds, so there's a higher degree of risk to them. And also, common stock, well, the income you get from stocks is from dividends. Not all stocks pay dividends, and even though and when they do, the dividend yield tends to be lower than it is for bonds because people usually buy buy stocks more for the capital gain, right? The appreciation in value, and buy a low, sell high. So that's not income, right? When the test means income, it means regular, steady income, right? Collecting regular paychecks from your investments, right? That's different from capital gains, which is, buy it low and sell it high. Okay, those are trading profits. That's different from income. Okay, would it choose, let's see, what about income bonds? I mean, they're looking for income, right? When they get income bonds, that is the worst name you could ever possibly give a bond because they don't give you income. Okay, they're also known as adjustment bonds. They're issued out of bankruptcy proceedings. Okay, because right, so the judge, basically the bankruptcy judge, cancels the debts and says issues orders to these income bonds, and they only make interest and principal payments if the issuer has the income to pay it. Considering it's a bankruptcy situation, that's a big if. So this is a very high degree of risk. These are the junkiest of junk bonds. How about mortgage bonds? Now, a mortgage bond is a corporate bond, and corporate bonds have a higher yield to them than certainly compared to government. And the risk level is more moderated because, as a mortgage bond, it's secured by real estate. So there's some collateral that's there to back up the bond should the case of default. So that might be a good one. Now, convertible bonds, well, convertible means that it can be converted into shares of stock and participate in the growth of the stock. But remember, the growth of the stock is not the same thing as income, right? That's capital gain, which is trading profits, right? Instead of regular steady paychecks. Convertible bonds, the advantage is that the bondholder can participate in the growth of the stock by swapping out for shares of stock and selling for a profit. The trade-off is that a convertible bond will have a lower coupon, a lower interest rate than a non-convertible, all else being equal. Investors are willing to accept a lower interest rate because of the potential of converting the bonds, okay, or in the stock. Question says, is risk relative to the buyer since they choose their own stocks? Well, in terms of a matter of risk, we know that stocks have a higher degree of risk than bonds do. Okay, right. The stock market is much more up and down like that. Okay, bond market is comparatively, right, much more even keeled. Okay, that's the thing. So it is kind of relative, but I would say more like relative to each other when we're evaluating investments. I hope, Amy, that helps answer your question. If it doesn't, please tell me. Okay, thanks, Amy. Okay. All right. Do we have more time? Okay, I think we have time for one more. All the following statements are true regarding corporate zero coupon bonds except A, zero coupon bonds do not offer investors a current return. B, zero coupon bonds are usually suitable for investments in individual retirement accounts and self-employment retirement plans. C, the interest rate on such obligations is not taxable until maturity. D, the rate of return for zero coupon bonds is not subject to reinvestment risk associated with interest paying issues. What do you think? A, B, C, or D? Okay, I've got 5 answers. And 1, 2, 3, 4, 5, 6. 6 people. Okay. Yep, you can change your mind. That's okay. That's okay. All right. All the following statements are true regarding corporate zero bonds, except this is an except question, right? Which means there's 3 truths and a lie. And we got to find the lie. And the lie is C, that the interest rate is not taxable until maturity. That's a falsehood. Zero coupon bonds is true, right? They don't make regular interest payments. They only pay once on maturity date. The difference in what you bought them for and what they mature at, $1,000 you get back. But even though they don't receive income all that time, they're taxed as if they did. They're taxed as it was called. They call it phantom income. Oh, upside down face. Okay, right. So let's give an example. So the bonds, zero coupon bonds, they mature at $1,000, but let's say you buy it now for $600 and it matures in 10 years. So, okay, so the difference is, right, $400 difference. Okay, but it takes 10 years, right? It's going to mature in 10 years' time. So in reality, they get nothing for 9 years, and then they make $400 in interest in year 10. But they're taxed as if they received, $40 per year over 10 years. As the bond basically stair steps upwards in value, right? As it gets closer to maturity date, it's going to stair step in value at the rate of $40 a year for the next 10 years. And investors who hold them pay taxes as if they made $40 a year. They're taxed on the accretion in value, right? The appreciation as it goes by. So when it starts off in year 0, okay, right, it's worth $600. I put a dollar sign, $600. All right. Okay, in year 1, after the first year, it's accreted, it's gone up in value to 640. After year 2, it's gone up in value to 680. Okay, and the year 3, it's gone up in value to 720, and so on until year 10 when it's worth $1,000. So even though they don't receive it, they're taxed as if they did. That is known as phantom income. And I'm trying to put this on the screen. Okay, phantom income. So therefore, C is a false answer choice. They are taxed along the way. Others are true. They do not offer a current return, right? You don't get anything until maturity date. But because of this, they are actually, because they're taxable, right, every year, that does make them suitable for retirement accounts. Because in an IRA, you don't pay any taxes until you take the money out years later, right? It grows on this tax deferred basis. So you don't have to pay any taxes until you take it out, presumably after they've retired. So we don't have to worry about the annual taxes on them. And it's also true, right? They're free from the reinvestment risk. Reinvestment risk happens, well, when you have a bond that pays interest. Well, when the bondholder collects that interest payment, unless they're going to spend that money, they're going to put it back to work. But if interest rates have gone down since that bond was created, they won't get the same rate of return they did before. They'd face a loss of income. Since zeros don't pay interest rate, there's no money coming in to reinvest. So it eliminates reinvestment risk. Okay, well, hope that helps you out a little bit. And again, if that didn't help you out, please let me know so I can make sure it's clear. Okay. All right, so yeah, we're all good for the day, right? It's a quarter top of the hour, so it's time to let you out the door. I am again. Please consider to continue to take your practice questions. Get caught up. I sent everyone at least at the time what I saw was the things that they were still missing or still need to do, or things that some of the like the tests that they could redo. Right? If you scored less than 70% on it, try again. Okay, keep going and score some more points because we always record your highest score. So squeeze some more points out of it. That way, my pleasure, Karina. That way, because once people have passed, once they've got the scores they need, then I can tell, okay, then I can call Bill over at the school and have him order your vouchers. Okay. All right. If we're all good, again, you do have my email address. I presume you do. All right. And by the way, my offer to you for one-on-one individual calling is still a good offer. Interestingly enough, not too many people have taken me up on that offer. So, so buck the trend, okay? Give it a try. Thank you, everybody. We'll see you again next time. My pleasure, Ashley. Sure thing. Take care, Karina. Y'all have a good one. Y'all come back now. Yeah? Okay. See you later.